Let's get back to stocks, too, because they are slipping a bit today following 5 straight weeks of gains. The S&P 500 notching new highs for the year on Friday. Now we're seeing this slip today of right now around 0.75%. In a roundup of 12 S&P 500 forecasts for 2024 tracked by Yahoo Finance, 5 have the S&P hitting 5,000 or higher by the end of next year, and that includes RBC. Here with more is Lori Calvasina, RBC Capital Markets Head of UX Equity Strategy, who is one of those folks. She's looking at 5,000 for next year. Lori, thanks for being here. Thanks for coming in. It's good to see you.
It's good to see you too. Thanks for having me.
So I know you guys have sort of quantitative models and you go through and look very systematically at what's going to get us to a certain level next year. Maybe it's hard to answer this question, but is there one thing overall that you think implies bullishness for 2024?
So I would say the thing that comes up the most in my meetings, and it's actually the most bullish out of our 5 models, but it's the one that really seems to resonate with investors and be a little bit differentiated versus some of those more bearish forecasts, is our valuation work. And quite simply, we think that most of the strategists on the street are underestimating how high PE multiples can stay. And if you sort of think about your typical, sort of arguments for valuations, it'll be, oh, this has been the average since whatever date, and we're plugging that in against our earnings estimate. And I've always thought there's a better way to build that mousetrap. I've been doing strategy for more than 20 years. And so we've built a model that is based on data going back to 1962. We have 4 inputs: inflation, we use PCE, Fed funds, 10-year yields, and GDP. GDP is actually kind of a garbage indicator, doesn't matter all that much, but PCE and 10-year yields work great. And what's interesting is that if you look in the 70s, PCE, inflation, did the most work at explaining, or did the best job of explaining movements in PE multiples. Recently, it's been 10-year treasury yields. Long story short, and I know this has already been a long story, the moderation in inflation can push the PE multiple up above 20 times. I see a lot of people who are using 18 times or 17 times or 15 times was really popular over the last year. And if you take the math, and I think our model spits out 23 times for the end of next year, take it against our earnings forecast for next year, we actually think on a bull case scenario, you could get all the way up to 5,300 on the S&P, and the multiple would be defensible. That is probably, I would say, the most interesting conversation I have with clients right now, because people are using these really low PE assumptions and don't have very good justifications for them.
And Lori, so valuation looks constructive. I'm interested to get your take on sentiment too, because I've seen some of your colleagues, some strategists sound like they're getting kind of nervous about that. They're looking at certain sentiment indicators and they think, you know what, these look kind of extended right here, and it's caused them to feel a little bit more cautious, at least short term. What do you see? So
I do think sentiment's been a very important star in the sky this year to navigate the U.S. equity market, and it is oscillating very, very quickly if you look over the last few months. When we priced all of our models, we were still not really in danger territory from kind of an overly exuberant point of view. If you looked at the AAII Net Bull Bear Survey, you were still kind of in neutral territory, and we're definitely moving up very quickly, so it is something to watch. But what we do find is that we've been in this range, we bottomed out, basically in early November and got a very strong buy signal for the market, and we're rebounding from that, but it's giving us a very strong signal over the next 12 months, even if it might be getting a little bit worrisome in the short term.
Well, I want to linger on the short term for just a second here, because, we heard from Jay Powell on Friday, and people seem to sort of ignore what he was actually saying and just heard what they wanted to hear in terms of rate cuts being absolutely done. We've got some important data coming up. We've got the jobs report coming up. We, of course, have more inflation data coming up. Are we going to see a damper being put on this rally, continuing to be put on this rally?
It feels like we've moved very far, very quickly. It would not be surprising to me to see the rally take a breather at some point in time, and that doesn't necessarily have to mean you're doom and gloom for the next 12 months. We did get to a point back in August where sentiment was looking too frothy, and that had unwound by the time you got to November. So there's certainly recent precedents for saying, hey, the narrative could change and we could knock some of the froth out of this market, but that could just be a pause that refreshes. It's funny, I was talking to a client last week, and they were just they were working on their own year ahead outlook, and they were just like, the narrative just changes every 5 minutes. And it feels like investors, especially regarding the Fed, are getting very, very frustrating with that in terms of how to position.
And Lori, another variable to consider as we roll into this year is an election year.
Yeah.
How as a strategist do you think about that? Because as you point out, that also introduces just another level of uncertainty for investors.
So I've described it, if you're talking to your typical US investor, it feels like you're staring at the sun. They have to talk about it for like 5 seconds and then they turn their head away because it's just too painful to think about. If you're talking to a non-US investor, they are more willing to linger on it, especially I would say European-based investors. It feels like American politics has become a bit of a spectator sport. There's a lot more concern, I would say, from non-US investors than US investors. I prefer to stick to the data, and data shows you that every presidential election year has a bit of uncertainty in it, and trends tend to be, in terms of market gains, positive, but below what we typically see in the year prior to a presidential election year. I think we've got enormous uncertainty next year. It's not clear that economic issues are going to be driving the turnout. I think that really has Wall Street turned on its head right now. I think there are lots of questions about how accurate polling data is going to be. That also frustrates Wall Street people. We like to look at numbers, and it's not clear you can rely on them right now. And I think people just want it to be over. I will also tell you there's not a lot of sector work to do here right now. This is a broad market risk, but the policy discussions have been light. So even if you want to make a bet, it's hard to say you need to sell this sector or buy that sector if you have a view on a certain outcome, because we're just not deep into it enough yet.
What about sector work, though, just broadly? You know, if you're not entirely sure what to do on the top line here, I mean, for example, you've been talking small caps for a little while now here.
I know. It's funny. I had someone yell at me last week for not being bullish enough on them. I'm like, I actually really do like them. I said I've just liked them for a really long time, and I keep getting, knocked back down. Yeah. But I think what happened, I was up in Montreal on November 1st, right after Halloween, and they were putting up all their Christmas trees everywhere, which I guess is what they do. And it felt like talking to kids on Christmas morning, because people were like, okay, 10-year yields have peaked, what do we buy? And people were really kind of ready to price in the idea of a less aggressive Fed and interest rates moving down over a longer period of time. Small caps came up a lot in that discussion. And I would say back in, sort of August, September, when 10-year yields were melting up, people were just kind of stuck. There was a lot of paralysis. People didn't want to hear about small caps then. But now that we're into this different rate environment, people want to hear about the fact that small caps do usually outperform when the Fed starts cutting. Small caps are at historic lows relative to large caps. And there seems to be this readiness. You can even see it in the price action today. Small caps are up, everything else is down. People are ready to broaden out a little bit.
When is the Fed going to start cutting? Because that's really seems to be one of the central areas of debate right now.
So I luckily don't have to make this forecast. Yes. I've got my hands full with the S&P and the small cap call. But our economists actually just put their forecast out late last week, and they're saying mid-year. And that's a call that they've had for quite some time. And one of the things they talk about, they're not looking for a hard landing in the economy. They see some modest declines in GDP in the first half of next year, not consistent with a recession, but more similar to what we saw in early 2022, which was not termed a recession. So they don't think the Fed is going to be reacting to any big, bad, nefarious economic data, but they think we're going to see a series of adjustment cuts. So.
Well, and if I could just quickly follow that, so you don't make that call.
Yeah.
But obviously there's an effect on stocks. Yeah. What's the sort of most important thing for investors to think about in terms of the timing of when the Fed is going to cut?
So I think that, it's always a little bit different. All these Fed playbooks, they never play out exactly the same. I think that right now we're in a point where people have just been sort of stuck in the same trades for a long time, and then again, stuck not really knowing what to do for a period of months. People are ready to do something. And so now that they feel like they have Fed cuts coming into view some point over the next year, I think people are ready to position on that. And you'll see that impact December trading. You'll see that impact January and February flows as well.
All right. Lori, thank you so much for coming in today. Appreciate it. That was really helpful.
Thanks for having me.